Welcome back to the Cryptolabs YouTube channel, guys. My name is Gordon, and today we're looking at the 7 entry criteria that you need to know when entering DeFi liquidity pools. If we jump straight into it, you can see on my screen here, we've got a behind the scenes sneak peek of some of the amazing content we've got in the UIG for all of our members. You can check that out down below in the description. But we're going to be looking at these concentrated liquidity entry criteria because once you get proficient at looking at different opportunities in the DeFi sphere, it's important to have a checklist of criteria that you can run through at a very quick level in order to understand the extent of the opportunity that you're possibly getting yourself into and how we can actually earn some very good yield from understanding the differences and the nuances with some of the things we're about to look at in this list. So jumping in straight away, we can see that understanding the underlying assets is the first criteria when entering a liquidity pool. Again, it's very easy to get carried away with some of these very high yields, and a lot of clients and people end up chasing yield. You see very high APRs, 300, 400, 500% APRs. It's very easy to get carried away looking at the APRs on some of the opportunities in the DeFi space. But fundamentally, if you are not ultimately bullish on the underlying assets in the pools that you're entering, then it's not going to be something that you can stomach when you get those inevitable 15, 20, 25% pullbacks in the market. And we know that they can happen very, very frequently in this crypto space. So you need to ask yourself these questions. Would I be okay holding each of these assets for the long term? Again, I always ask myself, would I want to hold these assets for the next 3 months? And would I be comfortable being in this pool for the next 3 months? You want to ask yourself other questions like, would I be okay getting fully converted into each of these assets? Because again, if you go out of range to the upside on your pool, you're going to get fully converted into the quote asset. If you go out of range to the downside, you're going to get fully converted into the base asset. You need to be comfortable holding both of those assets in the pool when making a decision about whether you want to enter and actually get into the pool. Okay, you need to ask yourself those questions, have a strong foundation. Do you want to hold those assets for the medium to long term? The second criteria in our list is the TVL of the pool. And we're going to jump over to Crystal here very quickly to take a quick look at one specific opportunity. I've shortlisted a WETH USDC pool or pair on the Arbitrum network. And you can see we've got multiple different fee tiers here. And we normally say that having a minimum TVL of at least $250,000 is what you want to be looking for when entering a pool. Why do you say you need 250K? Well, basically, you don't want to end up making up too much of a percentage or too high a percentage of the total TVL of the pool, because you'll end up paying a huge amount in slippage trying to get in and out of that pool, especially if other liquidity providers begin to pull their capital out and you are left having a larger percentage of the pool with your capital. You could end up having to pay hundreds, if not thousands of dollars just to remove your capital. So all of these fee tiers technically meet our criteria, but you can see that the 0.3% fee tier for this particular opportunity, WETH USDC on Arbitrum, barely is above our minimum criteria. So I'd be looking at other pool opportunities with much higher TVL and volume, which we'll come on to in just a moment. But that TVL is very important because you want to have lots of liquidity in there from other people in the pool. Correlation is the third criteria you need to think about. Again, are the assets correlated? Are you going to be able to have a long amount of time in range after you enter the pool? And you can use the DeFi Llama correlation matrix for this if we bring it up here to compare the correlation coefficient between any two given assets. So let's just compare Bitcoin to Ethereum very quickly, because I know there's a lot of people in pools with CBBTC paired with ETH, for example. We can see over different time frames what the correlation is between these assets. And again, our minimum criteria here is a positive correlation.
Gonna hop in here and just interrupt you for a quick 15 seconds. I think a lot of people in this space are doing DeFi alone. That's the big reason we have this YouTube channel, so you don't have to feel like you're doing it alone. But if you are looking to get a little deeper into a world and join the UIG, which is our community of 1,500 plus members. We're really active in that community. We got a ton of live calls and articles and research and something going on every single day in the UIG. If you want to learn more about that, we will put a link in the description below. Check it out. And if not, keep enjoying the YouTube video.
Coefficient of at least 0.5 or above for the assets that we would consider highly correlated. So again, you can see Bitcoin and Ethereum with a score of 0.76 here. That's a pretty good degree of correlation. Over 1 month though, technically they're at a 0% correlation. And over 1 year, they're just barely above our minimum criteria. And again, a lot of that due to Bitcoin actually outperforming Ethereum over the course of the past year. So the correlation is the next question you need to think about when analyzing these pool opportunities, because if the assets are not highly correlated, they're going to diverge and it's going to cause you to go out of range even quicker. The next criteria to look at is the trend. What's happening on the chart from a technical perspective? And again, if we bring up the Ethereum chart, for example, we can see Ethereum has been moving somewhat sideways and actually in this downwards trend for the past couple of months. Again, really since the beginning of December, we haven't seen Ethereum making bigger moves to the upside. We've had some peaks and troughs for sure, but overall it's been in this kind of descending triangle here. We could be on the point of breakout, but you want to consider the trend. Again, if we look back here during this period, August through November of 2024, Ethereum was moving very sideways for that entire period. This was actually a good opportunity to be providing liquidity because you could have been in range for an extended period of time while Ethereum moved sideways and gotten some very nice yields. Okay, checking out the trend. Are we in an uptrend? Are we in a downtrend? Are we in a sideways channel? Again, each of them pose unique and different types of opportunities for liquidity provision, but you want to understand the general trend when you're entering a pool. Okay? The next criteria we're going to look at is volume to returns, or volume to TVL ratio. And again, we're going to jump back to Crystal here because we're looking at our example here for ETH USDC over on the Arbitrum network. And again, ideally, we want our 24-hour volume to be at least equal to, if not greater than, the TVL of the pool. Okay, we can see here on the 0.05% fee tier, we've got a very healthy volume to TVL ratio. Okay, we can see the volume is clearly, 3, 4, 5 times larger than the TVL of the pool, which means that we have the potential to generate lots of good fees because there's a huge amount of volume coming through the pool and a good healthy ratio between that volume and the TVL. Okay, if we look at the 0.3% fee tier, we can see we technically don't meet the criteria. We've got 24-hour volume of 560K, but the TVL of the pool is almost double it. So the TVL is 964K, and we can see the 24-hour volume is below it. So again, technically this would not meet our criteria, but the other thing I do like to check out, and you can open up the pool analytics directly on Uniswap with this button, is the consistency of the volume over time. Okay, if I zoom out to the 1 month view here on the 0.05% fee tier, we can see some good consistent volume. And again, on the 1 year time frame, nice and consistent volume coming through this particular fee tier. So consistency of the volume is another trend I want to analyze as a liquidity provider. Okay, next up, we've got the actual DEX. So where are you providing that liquidity? Again, with this particular example, we are looking at WETH USDC on the Arbitrum DEX. But you do have opportunities to supply liquidity to the same pair, WETH USDC, across other DEXs. You could be providing liquidity to WETH USDC over on Aerodrome. You could be providing liquidity to WETH USDC on PancakeSwap or other DEXs where there's opportunities to provide liquidity to the same pair, the same assets, but you could be getting very different results. So it's worth comparing and contrasting those different DEXs and the rate of return you could get for the different pools with the same asset pairs on those different DEXs to see if you can maximize your yield depending on which decentralized exchange you're actually using. And again, you can use Crystal to simulate this. For example, on Uniswap, we can click into this 0.05% fee tier and we can use Crystal to actually plug in a minimum and maximum range for our concentrated liquidity, run a simulation and see what type of yield we'd be earning, and then we could come back here and filter for a different DEX and compare the same asset pair on a different DEX to simulate what type of yield we could earn, compare and contrast, and ultimately provide liquidity where we're going to get the best yield. And finally, the last criteria we're going to look at, guys, is the blockchain, or which network we're actually using to provide liquidity. Once again, you might find you might get better or worse results depending on the specific blockchain you're using. If we look at this example again, we're looking at WETH USDC on Arbitrum, but we could easily filter by going over to Base and looking at WETH USDC options on Base, and you can see we've got opportunities to provide liquidity across Uniswap, PancakeSwap, and SushiSwap for this same pair on those different DEXs, but it's on the Base network instead of being on the Arbitrum network. And once again, it's advisable, or you should think about running simulations to understand what type of yield you could earn depending on which blockchain or network you're providing liquidity on. Again, you might find the results may not be that drastically different, but depending on how much volume a particular DEX is getting and how much volume a particular network is getting, because we're seeing huge growth with networks like Base and Solana in this cycle, for example, that can have a big impact on the type of yield you can earn by providing liquidity. So I hope that video was helpful, guys. Again, check out the stuff at the link in the description below. We have tons of resources in the community. You can come over and check them out for yourself. Lots of great criteria, checklists, and all those different types of resources in the community. Check it out below for yourself. Let us know what other kind of content you want as well, and we'll catch you in the next video.